with Business Breakfast.
Welcome back. We're just past 8:30 here in the east. Looking at the local market this morning, we're expecting to follow on from Wall Street's positive lead there with those SPI futures up 14 points. Keeping a close watch on the Aussie dollar as well ahead of today's Westpac consumer confidence reading. Also making news this hour, Aurora reporting a higher half-yearly net profit up over 12% and half-yearly revenue at over $2 billion. And Domino's Pizza reporting half-yearly revenue up 5.2% to $560 million. So there's a lot of company reports out this morning, and just on Domino's actually, because we might just sort of flag that a little early, but those net profits up 17% to $59 million. Revenues, as we mentioned, up 5%, an interim dividend of 58 cents per share, and they still are expecting their FY18 net profit growth of 20%. Their first half network sales up 7%, same-store sales up 4%. They're expecting their Australia and New Zealand same-store sales to grow by 6 to 8%. That's down from about 7 to 9% that they had previously forecast. So let's actually bring in James Gerrish, who joins us now live from Shaw and Partners in Sydney, for a bit more on these numbers. James, just on Domino's, I know that you've kind of had a chance to get across some of the numbers, and just looking at that last line there, they've sort of downgraded their estimate for their same-store sales here in Australia and New Zealand. Overall, though, what have you made of those numbers for Domino's?
Yeah, good morning to you, Leanne. It looks like a miss to me in terms of the NPAT number. So I think it's about a 10% miss in terms of that line. Dividend was slightly better. What they're saying is that the full year guidance is being maintained for NPAT growth of plus 20%. What that implies, though, is a big second half skew. So you've got to be a little bit confident there that they're going to produce in the second half. I would say that their same store sales number for January and up to the 4th of February of this year has been progressing well. So they're guiding for same store sales growth of around 6 to 8%. They're printing around 7% over that time period. So look, that looks good. So the first month and a bit of trading conditions looks firm, but they've got to produce a really strong second half. So, you know, in my mind, it's a miss, and it's whether or not the market will believe them in terms of their second half skew.
Is it fair to say that a lot of their growth, though, is not so much coming from Australia and New Zealand, will reflective, I suppose, in that slight downgrade with their sales? A lot of their growth is actually coming from their overseas operations, particularly across in Europe.
Yeah, well, if you look at the same sort of sales numbers for the first couple of months of the year, ANZ is producing 6%, Europe is 7%, Japan's at 9%, and that drops down to a group number around the 6.9%. So you can clearly see that Europe and Japan are the two driving forces. That's where it's you know, they're rolling out more stores. So they're only rolling out 2 new store openings. They've only rolled out 2 new store openings in the first 6 weeks or so of the 18 calendar year. And 5 in terms of the group. They've rolled out 2 in Japan, etc. But most growth is going to happen overseas.
All right, excellent. Let's talk about CSL, because it's, well, gosh, you'd have to say still on these lofty valuations, and I guess it's another report really that's had to kind of meet the market's expectations given the big rise that we've seen. Now, just to take you across some of these numbers just on the screens, their half-yearly profit up 34.9% to $1.1 billion US. Their half-year revenues from those continuing operations up 12.8% to $4.1 billion, and an interim dividend of 79 cents per share has been declared here for CSL. So a rise there at $1.1 billion US. Certainly still seeing underlying earnings growth, I suppose. But James, again, it's all about how this one will sort of meet the market's expectations, isn't it, given the lofty valuation for shares?
Yeah, totally. And on my numbers, I'm not sure if that 1.1 I think you made mention of there was the half-year NPAT line, but if it was, that's a very big number. It's ahead of what the street was anticipating. The dividend was a lot stronger than what the street was anticipating. So it's a big variance than what I'm seeing. So I'd probably check that number before commenting too much on it. I mean,
sure.
You're exactly right around CSL and the run that it's had, the multiple that it's on. It has to deliver, but it's got a huge hugely strong track record of delivering and beating on guidance. So what you tend to see is the market gets ahead of what the company's guiding for. They preempt a beat to guidance. So look, I'd do a little bit more work on that one before commenting on it, Leanne.
Is this a preferred play though, a preferred healthcare play if you were to get in it? And yes, I know it's on expensive levels. On any pullbacks, is this one that you would kind of jump on board? How does it fit within your portfolio?
Yeah, deep pullbacks. We don't own it at this stage. We've owned it a few months ago and sold it too early. I'll put my hand up and say that. It comes down to whether or not you believe the ongoing growth is possible in CSL, and then that dictates where you can buy the stock. So look, I wouldn't be interested in CSL back unless it came back down sub $120. I probably doubt it's going to get there. You need some sort of short-term shock in the share price to get there. I'll look more closely at what's happening in US healthcare stocks and what trends we can look for or apply in the Australian market. So to me, the US healthcare sector is peaking out. It's been the place to be invested over the last 4 years, but it looks like we're starting to see some weakness in the US healthcare stocks, and I think that will eventually flow into what we see here in the Australian healthcare space, led by CSL. So look, I'd be cautious on it at the moment, but the caveat is I've got this one wrong and haven't owned it with a strong run up in share price, Leanne.
Yeah, sure. All right, now we're just seeing Computershare coming across the screens at the moment as well. Half-year net profit up 14%, $171.2 million. Half-year revenue up 12.4%, $1.12 billion. We also saw Goodman that was out a little early, and I'm not sure if you've had a chance, James, to have a look at those numbers. Yeah. Looks like improved guidance, though. Even though we've seen a slight fall in those net profits, improved guidance from Goodman.
Yeah, Goodman, that is a better guidance number in terms of Goodman. So they've increased their guidance to 8% earnings growth and that was up from 6% earnings growth. So look, it's a better number. We were ahead of the street. We were ahead of that 6% guidance that Goodman was previously given, but we weren't as high as 8%. So that's going to come as a positive surprise for the street, I would imagine, and we'll see Goodman, I would think, higher on the day, largely around that upbeat guidance going forward, Leanne.
We are still waiting for Woodside, I note, because this is going to be one of the heavy hitters, I guess, today that we'll all be watching. I haven't seen that one coming across as yet, but I think there was quite a big forecast for profits, wasn't there? $1.06 billion, I think that was a median forecast of about 8 analysts. That would be a rise from the $868 million a year earlier. What is your expectation for Woodside before it comes through?
Yeah, underlying NPAT of just over $1 billion US, so $1.013 billion, underlying EPS of $1.20 US, and dividend of 48 cents US. I think that the main thing is around updated production guidance as well as CapEx guidance and OpEx trends. So look, it'll be they gave a quarterly recently, so they gave a lot of information in the quarterly that they gave a month or so ago. So don't expect too much earth-shattering in terms of Woodside, but it is going to be around the guidance around obviously production and then the levels of spending that they're doing. So EPS $1.20 US is our expectation, Leanne.
All right. Fantastic. Look, we've managed to get through a fair bit this morning, James. Maybe we can just get a thought from you on the broader session. Positive move, it looks like, into the close for Wall Street. How do you think that will see us tracking today?
Yeah, it's really interesting. Obviously, we had a massive week of volatility last week. The volatility index spiked at the back end of last week when the market was making a new low. The volatility index didn't make a new high. So that gave us some confidence that some of this volatility was dissipating, and I think that's what's played out at the start of this week. Today's main focus will be on earnings, so which is nice for a change. We didn't have a lot of focus on earnings last week. Today we can focus on earnings, but to me the market looks like it's going higher. I think this short-term route is coming to an end. The caveat being that US inflation data is out tonight, obviously in the States. That's going to be key in the short term for markets, but I doubt we're going to get a really strong inflation number just because we've had a strong recent wages number. I think there's a time delay or lag between that going into or having an impact on the inflation print.
All right, fantastic. James Gerrish, always appreciate you joining us with all of that analysis this morning. Thank you so much for your time.
Thanks, Leanne.
Now, I am joined in the studio by my guest host this morning, Raymond Lee from Capstone.